Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, will provide you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome to the Real Estate 360 program, your number one source for all of your real estate needs here in the Bay Area, where we provide you with the information you need to make the best fact-based decisions. By popular demand, Real Estate 360 is growing from a once-a-week weekend program to a Monday through Friday daily program beginning October 29 at 3 p.m. So don't miss us during your commute time or wherever you may be Monday through Friday starting the week of October 29. I'm Tom Wilson, your new host for the Wednesday edition of Real Estate 360. It's an honor to be a part of the radio KDOW and the Real Estate 360 team. We have a great program for you today with featuring guest Richard Smith, who is a veteran real estate investor, 30-year accountant and enrolled agent, and Richard will share with us some of his insights about how to best plan for upcoming tax changes in the real estate business. First of all, just a couple words about who I am, since I'm your new host. At the end of the program, I'll give you one of Tom's top tips of the day. But I'm a 37-year real estate investor, an engineer who converted over to real estate back in 2000, came to Silicon Valley in '69, been here 43 years, live in Saratoga, and I certainly welcome any of your questions or suggestions on subjects that you'd like to have covered on the show. You can reach me on my website at tomwilsonproperties.com, where also there is plenty of investor education information that you're welcome to utilize. There's no cost or sign-in or to do that. If you would like to have a weekly newsletter on the economics as they apply to real estate on a national basis, you're certainly pleased to sign up for that as well. We have had a lot of experience in buying and selling real estate over those 43 years, especially in Dallas-Fort Worth in the last 12, 13 years. And we currently have about 230 doors in my own portfolio, and we have a business, Wilson Investment Properties, that provides high-quality rentals to investors throughout the country, and especially here in Silicon Valley. So let's talk with Richard Smith. He's been a longtime friend of about 27 years, accountant, mentor, and it's a pleasure to have you on the program, Richard.
Thank you, Tom.
Richard, the first thing I'm going to ask you is that you've always been a really great barometer as to what's going on here in the Bay Area, because you have, I guess now you're close to 1,000 clients, don't you?
Yeah, Tom, we have about 700, but I appreciate that, but almost there. We'll be there soon. Okay.
And by talking to them each year, you get a pretty good cross-section and flavor as to what's going on. Now, because you're so experienced in real estate, and certainly nothing more valuable than someone giving advice who is in those same shoes. So since you have a lot of real estate, you're very knowledgeable about it, and you tend to attract, I think, a lot of clients who have investments. Probably, half of your investors have real estate investments?
At least half our clients own investment real estate, and we find more people looking towards real estate today than ever before, because the returns on other investments have slumped over the last few years, and of course we feel this is an excellent opportunity because of interest rates and and what's happening with projected rents.
What kind of trends would you say you saw this year as you're interviewing each of your clients as they come in for their tax returns and their tax year? I know I remember you telling me in 2008 and 2009 what terrible stories you were hearing, and you felt almost like a family counselor as much as an accountant, and it was awful to see people hurting. Are you seeing people starting to gain confidence back? How much uncertainty is there? What kind of trends did you see with your clients this year?
I see two things very common. I see rents increasing all over the country. I see low inventories, and people who are looking to buy are in the multiple offer situation everywhere. So it's more difficult to buy, but I think everyone realizes that rents have to go up, and we're seeing increases. San Jose had one of the largest rent increases in the country. So when I talk to my clients who are looking at their properties more closely, is that we realize we can raise the rents, and we find difficulty buying new properties. So those are the two trends that I see mostly.
What about the attitude of the buyer? The clients in general? Are they still feeling very uncertain? Are they still very nervous to make a decision or make a move? Or are you seeing that confidence starting to get a little better?
I think the first-time buyer has difficulty. He has to go through the financing cycle, selection cycle, and it's a lot of effort to pick that first property. My clients who are veterans and have been doing it for 20, 30, 40 years are looking for opportunities, the prices we've never seen before, and interest rates that are, we're used to paying, 6, 7, 8%, and today investors get money in the 4s. So it makes properties much better in the cash flow situation, which is, what we focus on. So you have a situation where if you can get financing, and it's not easy for everyone, but if you can find the property, it'll cash flow like it never did before.
Mm-hmm. Well, let's start talking about, let me ask you one other thing before we get to the tax specifics. What's your guess prediction as to what's going to happen after the election? How much is that removal of uncertainty, whichever way it goes, going to affect attitudes and the real estate market, in your opinion?
We're in exactly the same situation we were in the fall of 2010, where the Bush tax cuts are going to expire January 1. Nothing has to pass. These are always set in place, and the rates are going to go up January 1, 3 to 5% for each tax bracket. Capital gains are going to increase. So it's a repeat of what happened in 2010. The difference is, at the last week of 2010, they passed a new law, and they allowed the rates to continue. This year, we're not sure we have that situation, that they will allow the rates not to increase. So that's the difficulty we have. The Congress in place after the election will be the same one we have today. They haven't passed a tax law the entire year. We're definitely not going to pass one in December. So what's going to have to happen depends on the election. What the new makeup is for the House and Senate in January, when they come in to take their chairs on January 20th, we're going to have new tax laws in the spring, and they'll be retroactive to January 1. So we've done this before, and it looks like we're going to do it again. So nothing will happen this year, and we'll have to wait for the new Congress to set the new laws come springtime.
So what are the rate increases for 2013? How's that going to change?
When you look at the tax brackets we have today, 10, 15, 25, 28, 33, each one of those brackets will increase 3 to 5%. The one that we are most concerned about is the maximum tax bracket will go legislative. It will go from 35 to 39.6. So that's the maximum tax bracket. Will increase almost 5%. And so those are big increases for everyone. So everyone's bracket will go up. Everyone's tax rate will go up. And so it depends what the new makeup for Congress is, and if they decide to keep those brackets, or will they find enough votes to reduce them. That's the challenge.
What about capital gains? What's going to happen to that?
I probably get more calls on capital gains than any other question, because the current capital gains rate, if you own an asset, you've owned for more than a year and a day, like a home or a piece of stock, and you sell it today, 15% of that capital gain is what we'll pay for tax.
On federal?
On federal. California is 9.3. So we just use 25% for the for the profit to be taxed, and to determine that tax. So next year it'll go to 20% federal. California stays the same at 9.3. So people say, well, should I sell this year or next year? Well, we don't know. We take you and say, well, it depends on what it is and how it affects your entire portfolio. But that's the biggest question for people. Do I sell this year or next year? If you think rates will go up as they're scheduled to and will remain up, then you should sell this year.
Okay. What kinds of steps do you think a real estate investor should take right now in preparation for the change in the tax laws?
Well, it's like tax law in total. We don't know what's going to happen. If you listen to the debates, some interesting things are proposed. But remember, if the House and Senate then have to decide, and generally these are based on whoever's running who's running the ship in the Senate or the House. So, I listened last night to this debate what both candidates, Mr. Romney and Mr. Obama, wanted, but it really depends on what the Senate wants and what the House wants. And so, they all have their private little pieces that they would like to manage a little bit better, of course. So we are going to have tax law changes next year. We all know that. We're concerned about, do we keep capital gains at a higher rate, and what happens to our mortgage interest deduction? So it seems like everybody has their own little private part that they like. So I think when you look ahead, I think you have to manage what you have now, and things will change. That's all we can tell you, Tom, is we know it's going to change next year.
You've talked about when Congress comes back in January. What about the market attitude between election and January? Do you think that's going to affect supply or demand?
I think it all boils down to who controls the House, who controls the Senate. For example, a lot of conversation about the Obama health care plan, which also begins January 1. And the Republicans have said, we're going to repeal it. Of course, the Democrats would not do that. But again, you have to pass both houses, and if Mr. Obama is, of course, not going to repeal his own health care bill, so then you'd have to have enough votes to pass over his veto. So probably not going to happen. I think the Obama bill, so even if Mr. Romney was to get elected, could the House and the Senate agree? And that would depend. The Senate, it's very difficult to think it might become Republican. But I don't like to make judgments on party votes. But most things usually stay the same. We have a lot of noise, a lot of fury. The things pretty much stay the same, is what I've held over the years.
So what happens when if Obama health care plan does go into effect, doesn't get repealed?
Well, it will go into effect. The question is, can they repeal it?
Right.
So it will place decision burdens on the small business owners, whether they're going to provide health insurance to their employees. That's basically what the bill, it's got, 1,800 pages of tax law and regulations. But the biggest issue is, what do the small business owners do in regard to paying health insurance to their employees? Because now they won't have to, or pay a price to the government to provide, the government would provide health care to them. So it's a burden to the small business owners, and a lot of them have said that, they'll convert their employees from W-2 to 1099. They're not able to take an 8 to 10% hit on payroll. So, when I talk to my clients, I would say that many of them are not going to provide health care. I provide health care because I thought you had to. You don't have to, but you will have to in the future. So the question is whether you're going to provide it or whether you're going to pay the government, not the penalty, but the fee for the government to provide it. And so that's the situation that employers need to look at very carefully.
One way or another, it's certainly going to be a burden that will have to be accounted for somewhere.
And guess what? It'll raise prices on products and services. And, it all trickles down. If it costs you more to provide a service or a product, somehow you've got to recover it if you want to keep your doors open.
We're going to take a short break, and when we come back, we're going to have to ask you that certainly that age-old question that everybody wants to know about others' crystal balls and what's going on with interest rates coming up. Okay, we'll be back in just a moment.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360 with Richard Smith, a long-term investor and expert in the tax accounting and and talking about how the tax laws will affect our real estate in the upcoming months and ahead of us. I think let's talk about a little bit more about what steps should a real estate investor take to counter new tax laws? I think one thing you're suggesting is if someone's considering investing, now's a good time to go jump in and take advantage of this window of opportunity.
Absolutely, Tom. With these rates and with these rental demands, every day I hear people, and I think it's the best opportunity I've seen in a long time.
What tax law changes would they be considering relative to jumping in now? Is it more just that there's a buy opportunity, or is there other things other than the capital gains jumping up to 20% if someone's considering selling?
Well, I think the big one is the low rates to purchase for interest rates. That's what drives me. I can buy more property with low interest rates. I mean, the sell side doesn't really affect me because as a real estate investor, I can use 1031 tax-deferred exchange method to sell my properties and pay no tax. So the increase in capital gains has no impact on me as a real estate investor if I want to stay in the market. But the situation that I see is with the availability of financing, you can buy properties that I can get more rent, 10 to 20% more rent than I was getting 2 years ago. So that's what I look at is the opportunity. And as I look ahead, I think interest rates will increase. I mean, we think they're artificially held down by the government. They have to go up with time, and so therefore it'll make it more expensive in the future. And rents are going up every day. So opportunities like I've never seen in all the years you and I have been investing.
For the listeners that aren't familiar with it, can you explain a little bit the 1031 exchange?
1031 has been around for a long time. It's the code section for IRS code section 1031, which allows you to sell a property you've owned and purchase another property with the profit proceeds from that and not pay any tax on the sale. So if you bought a property for $500,000 and now it's worth $1 million, and you've got $500,000 worth of equity, through 1031 and use the 1031 company to help you, you can use that $500,000, not pay tax on the sale, deposit with the facilitator, and use that to buy multiple properties, 2, 3, 4 properties with that money, and pay no tax. I mean, we don't have that anywhere else that I've ever seen in the code, that you can sell an asset, take the money, and use it to make new investments without paying any tax. Rules you have to follow. Exchange companies will educate you on all the rules, and people use them every day.
It's amazing how many tax benefits there are to owning real estate.
Absolutely.
I find many people are not aware. They just look at it as maybe a good investment, but they aren't aware of how many tax advantages there are.
What I see every day, in fact, I just finished a bunch of tax returns Monday that were due. People who couldn't file on April 15th had it until October 15th, and so, I'm filing my return recently. And when I look at it, and even a small portfolio like I have, you're carrying depreciation on properties. You get to write your property off the purchase price over 27 and a half years today, and that depreciation, the write-off that you get every year, covers your rental income. So if you have a basic property and you're making, $200 or $300 a month, at the end of the year you made $2,000 or $3,000, an average property would have $3,000 or $4,000 worth of depreciation, offset that net positive rental income. So you don't pay any tax on it. So people don't realize how much benefit that depreciation is and what it means to you at the bottom line. Portfolio like mine, you're carrying $300,000 or $400,000 worth of annual depreciation that you can use to offset that income. What a great deal.
And unlike a private residence and second home that is restricted to the amount that you can deduct on rental property, since the mortgage is a part of the business expense, there's no limit to how much interest you can deduct.
That's correct.
Yep.
Your primary residence and your second home, you get the interest and taxes, which are excellent. We never had second homes until the congressman decided that most of them, since they had 2 homes, one in their home state, one in D.C., they should allow deductions for second home. Well, we're all glad of that, because now we can all have second homes and write off those interest and taxes. So, law is changing all the time, and that was a good change.
Well, we're going to take a short break again, and when we come back, we're going to talk a little bit about the possible changes of deductions on real estate, talk about what they are now, what the changes might be, and what a real estate investor can do in regards to that potential change. We'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360, where we're talking to Richard Smith about tax law changes and what we should do about it. Richard, what's the tell our listeners, if you will, about how deductions work with real estate, and then we'll talk about what changes might occur.
Well, one deduction, Tom, we've had for the last 2 years when they were trying to help the economy after the crash in 08 in 09, they came up with new deductions because that encourages people to purchase and buy. And so they decided to allow us to immediately deduct capital improvements if the life of that capital improvement was less than 20 years. So in other words, you put in a bathroom or a kitchen in your rental house, used to be you had to depreciate that over 5 to 10 years, all the toilets and fixtures and everything else. Well, they've decided that to help encourage you to do that you can now write off 100% in the year it occurred. That was true in 10 and 11. Guess what? Not true in 12. So the point is that things like this are available now, and I am surprised when I run into people who don't know that's available in the code. I mean, we all know about depreciation. They can't do it for your building. The building has a 27.5-year life for single families.
It's just for improvements.
For apartments and office buildings. But if the life of that thing, say it's a refrigerator or something like that you're buying, has a life less than 20, they expense the whole thing. Now, under bonus depreciation. Phenomenal deduction. And a lot of people aren't aware of it. So those are the things I try to tell my clients, that we're not going to have that kind of deduction next year. So
it expires at the end of 2012?
Expires at the end of 2012. Yeah.
Okay. So they and you don't expect that to come back?
I never know what's coming back, Tom. It always amazes me what they choose to come back with. But it won't probably be back.
While we're on the subject of deductions with the real estate, what's the so what do you think is going to happen to mortgage deductions? That keeps getting a lot of talk about it, either for personal home or for rentals. It won't change for rentals, right?
Rentals will always be a little, if you're buying a rental property, it'll always be, half a point higher than your residence. But, talking to my clients who are in the mortgage business, they can't handle the amount of refi activity that's coming across the desk today. So some banks are refusing to do refis. Others are restricting the number they do.
But there's no restriction on how much mortgage interest you can deduct if it's for business, the business of a rental property.
No, it's only restricted on your personal residence up to $1.1 million.
And do you think that's going to drop on personal?
There's no on your personal residence. You can only deduct the interest on loans up to $1.1 million.
Right. And do you think think that tax code might change? There's always been talk about.
Been that way for 20 years, Tom.
Okay.
I don't expect it to change.
Too many people in Congress have big houses, right?
Yeah. Well, what we worry about is when they start talking about lowering that $1.1 million to $500,000. That's what we all worry about. And again, you heard him mention it last night on the debate. That they might have a bucket of deductions or something in that stretch. But I think the Silicon Valley people in their primary residences do worry about losing that $1.1 million. We never thought 20 years ago that'd be an issue. Now the IRS is audited. I've had 3 clients audited, because IRS doesn't know how much interest it is on $1.1 million. Well, it's about $70,000. So and we had one that had 80, but he was $1.1 million. So you can't tell by looking at your tax return how much your mortgage interest is.
Yeah, unintentional consequences are interesting. Like I'm fascinated by the fact that many people who've held on to the houses a long time to try to take advantage of the low tax don't realize that the title insurance that they bought when they bought the house is still limited to the dollars they spent for it a long time ago.
Yeah, very few people know that. I've discovered that myself.
Yeah.
It's very unusual that it's almost worthless. It is worthless.
Yep. And the so on the deductions, by the way, I just wanted to ask you to verify it. I get a lot of folks that ask me, hey, if I'm going to go shopping around for real estate in Alabama or Minnesota or whatever, can I deduct that on my taxes? And your answer is?
Absolutely not. You can only deduct those expenses for that location once you purchase in that area. So say you're looking to buy, pick Alabama, you're looking to buy a rental property in Alabama, any costs that you incur, the travel, the hotels, the meals, all of those costs prior to the close of escrow are not deductible. Now, if you do buy associated with that property, those costs can be added to the property value, property cost, and depreciated over 20 years.
But you gotta own or purchase, right?
Yes.
Okay. When we come back, we're going to talk a little bit more about interest rates and push you a little bit for your crystal ball.
Good.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360, where we're talking to Richard Smith about upcoming tax changes and what the investor or real estate owner or buyer should do about it. Richard, let's talk about real estate depreciation a little bit. Is that going to change?
Right now, it's not scheduled to change. We worry about it every year, but no, it's scheduled. It's the same next year as this year, and has been for many years. We've had the same depreciation schedules basically for 20 years.
Since what, 86, right? And that is, why don't you explain what it is for those that...
Well, for the building, like we said, the building component, when you purchase a building, you have to determine how much of that purchase price is land, which cannot be depreciated, how much is building value. And that building portion is depreciated over 27.5 years for a single-family home. For commercial buildings, it's 39.5.
And for those who aren't familiar with it, that's another one of those beautiful benefits with real estate and investments is that generally in the first few years, the net cash flow coming in is less than the amount that you can depreciate, and the amount that you can depreciate is treated as though you wrote a check for it,
right.
But you really don't. So that income is basically fully sheltered, don't have to pay any tax on it.
Correct. Until
those wonderful rents get pressured up above the amount of the depreciation, and then you just pay for the amount that's over the depreciation. Right?
That's correct.
Yep. How sweet it is. So you don't expect that to change?
I don't expect it. There's no rumors in the mill. Everybody's conversation is, what about Obama health care? What about the new tax rates and capital gain? That's all we hear. And you can't pick up a magazine or an article anywhere without this conversation. What are we going to do? And what I'm telling my clients is, don't worry about it. For most people, you might have a 2 or 3% increase in rate, but you still have to consider taking deductions you can take this year. Do I want to prepay my California tax this year so I can take deduction for it? Do I want to prepay my property taxes this year? What is it worth to accelerate those prepayments and take them this year? Like we talked about the rental home. Do I accelerate those payments so I can take them this year? I'd rather have a deduction today than a deduction tomorrow. I've always felt that way.
No, that's great. Some listeners may not fully appreciate another aspect of a 1031 exchange, and that is that if you decide to just sell and pay the capital gains, there's another surprise for a lot of people, and that's the recapture, right, of depreciation.
Yeah, when you take depreciation, we should have mentioned that when we were discussing depreciation. We always say depreciation is deferred income. Every dollar of depreciation you claim while you own a building, if you ever put yourself in a taxable situation, in other words, you choose not to do the 1031, pay tax on your capital gains. We know capital gains today is 15% federal, 9.5% state. But all that depreciation you claim, if it's a taxable disposition, is also taxed. It's recovered and recapped, but it's taxed at 25% federal, 9.3% for California. So it's taxed much worse, than the capital gains part. So people are always shocked at that depreciation will come back someday when you sell it, and you will have to pay tax on every penny you ever took.
What are your thoughts and recommendations that might benefit landlords regarding January rental income?
Well, when we when we talk about it, we're trying to make a situation comfortable for our tenants, and there are people that always need special care. So, we sit down with a tenant, because there are people over the holidays that have a difficult time. So the question becomes, well, maybe I could defer payment of December rent. I hate to use that word, but, if I did, it would be taxed next year at possibly a little higher tax rate. But sometimes I can defer my rent into next year if the tenant's not able to pay it. They get, a lot of companies pay bonuses over the holidays, and people are willing to gather up on that. After being a landlord and doing this for too many years, I think, Tom, you're trying to make that a comfortable situation and help the tenant and see what you can do to make their life easier for them. So we look at those things and say, can I benefit, and yet can the tenant benefit? And one thing to consider is pushing the income. Now, I know it may be taxed a little bit higher rate, but you never know what's going to happen next year. I'd rather have a whole year to figure out how to save some tax than to worry about, what's going to happen in the next 2 months.
I like that. And while we're kind of on that rental income subject, just mention that a lot of people don't understand that a deposit that is held is not something that's a taxable event, and when you pay it back, it's not an expense. You should keep that separately, right? In separate accounts.
You can do it either way. IRS allows you to elect to declare as income and make the adjustment when you settle up. Most of us choose not to take it as income, and when we give it back to the tenant, it's a non-tax item. Now, that's best from an accounting standpoint, but security deposits are just another accounting term you have to deal with. But that's the way most of us do it. You can elect to claim it as income and settle when the tenant leaves, or you can do it the way most of us do it, is we don't claim it as income when we get it, and we give it back to the tenant. There's no deduction for it.
You have any suggestions on what investors should do about property tax? It's kind of a similar kind of subject for 2013.
Well, it's interesting. In California, because of Prop 13, there's not much you can do. What we have found in the last few years, people who bought properties in the last 5 years where the property values have gone down, in some areas, of course, you can protest those every year, and I've protested some of my own. And you can go in. There's an open window between July, August kind of months. You can call the assessor's office and find out. And you can appeal to have your property taxes reduced if your property has gone down in value. And they're very, I'm not going to tell you it's easy, but we've had some success with getting our property taxes reduced. The second one is once you leave California, most states assess properties, some regularity, every 1 to 3 years. And so in these places outside California where we own properties, we protest our property tax assessments out there and have good luck with it. So I think it's something you have to pay attention to, just like insurance. I think the same thing is true about insurance. So if you're going to be an investor, you've got to get smarter and decide what you're going to do about property taxes and insurance both.
What kind of prepayments can be made other than property tax and possibly?
Well, you can prepay for your business, and there are a lot of business deductions. You can prepay expenses for your automobile. The charitable deductions can be prepaid. Ones we look at, job hunting. If I go job hunting this year, you can prepay tuition. You can prepay child care. There are lots and lots and lots of things you can prepay in December that may be due in January, and that's what we do every year with our clients. A lot of clients come in to do year-end tax planning, and that's our major goal: determine what your tax liability is, and then determine if there are prepayments that would benefit your situation this year. And there's always things you can prepay. You can prepay your children, if they're helping you on your rental properties. Prepay your children to help you do cleanups and painting and trash outs and things like that. So lots and lots of things to do, and your children can earn $5,000 and under 18 and pay no tax.
Oh, I can see some folks out there with the light bulb going on that hadn't thought about that before.
There's lots of things. Prepayment has got, we have on our website 50 things you can do to help you at year end.
Well, when we come back, we're going to take a break. When we come back, we'll let folks hear how they can get access to that and talk another couple minutes about how taxpayers can pay less taxes for this year. We'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360 with their special guest, Richard Smith, who's an accomplished investor and longtime accountant who specializes in real estate tax code and accounting. Richard, let's wrap up here with a couple pointers on how taxpayers, what they can do if there's anything left this year to do that to pay less taxes. What is there that can be that they can do before the year's out? What would you suggest?
The one I always mention to my clients, because it's an obvious one, your January house payments due January 5, January 10. You can pay that in December. The check must be dated December 31st, but you can take 13 months worth of interest this year. Now, it won't agree with your statement that you get from your lender, but that's easy to change, if you ever got audited. But we have clients every year who decide. Now, again, if you decide to prepay it to get that extra $1,000 to $3,000 deduction. Next year,
how big a flag is that?
It's not a flag. It's not. Remember this: you pay at the month end. So when you're paying January 5th, you're paying for December's interest.
But I mean the fact that it would not agree with the 1098.
Then you get a statement from your lender, or you provide your own statement.
Okay.
It's very simple. Everyone in this listening audience could do that and save $1,000 more in their income tax. I think it's a great way to do it. And next year you have the flexibility of what do I want to do next year? Am I better to pay or not pay next year? Because if you go back to your old method, you're going to get 11 months. But
right.
I think that's the simplest and easiest one to prepay. Then your property taxes and your California taxes are the other big ones we think about.
Okay. Any others you can think of other than prepaying?
Well, the charities are big. The non-cash charities. Empty out your garage to make some room for new stuff coming in, and take that stuff down to your favorite organization. I like the job hunting.
That'll make some spouses happy.
I mean, there's so many things you can't go through. That's why hopefully the people will go to our website and look at our list. And my website is richardsmithtax.com. And my phone number here in Cupertino, been for 30 years, is 408-446-5551. And my email is richard@richardsmithtax.com. So lots of things you can do before you're in. You can make a difference in your taxes, and then you're going to be able to turn a balance due maybe into a refund by doing some things you're going to do anyway during the first few periods of 2013 by taking those this year. I love it. I love to get money back by doing something I'm going to do anyway, but let's get some money now.
Richard, thank you so much for being on the program. I know we want to have you back another time and talk about investing itself, since you've been an investor for such a long time and so successful at it. And thanks for giving us some tips for taxes on this year. And I'm sure some of the listeners have more questions they would like to contact you with.
Thank you, Tom. I enjoyed it. It's always fun to talk real estate. Thank you much. Bye-bye.
Thanks for being on the program. I promised you I'd give you one of Tom's top tips here at the end of the day, and we want to talk to you about not underestimating and undervaluing your generalist skills. So that's something that I think, in my experience, both in high tech and in real estate business, that many people don't understand. So don't throw away and forget about all those things you've learned in whatever day job or industry that you're in. Make sure that you carry those, whether it's managing people or marketing, whatever you learn in your generalist skills at one career, carry them over to real estate investing or anything else that you do. Well, thanks for tuning in to our Real Estate 360 program on KDOW, your number one source for all your real estate needs here in the Bay Area. Remember, Real Estate 360 is growing from a once-a-week weekend program to a Monday through Friday daily program, beginning on October 29 at 3 p.m. We hope you can join us next week when we'll have another expert guest in the real estate business, and we look forward to having you back. Remember, if you have questions or suggestions for content or subjects you'd like covered, you can go to the website, my website, tomwilsonproperties.com, or call at 408-867-1867. So this is your host, Tom Wilson. Thanks for listening, and remember, the only thing that matters is what you do next.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. AM 1220 KDOW.